Good morning and welcome to TOITOI Japan Market Radio for February 3, 2026. I'm your host coming to you from Tokyo with the latest market intelligence for global investors tracking Japan exposure. Today we're digging into some significant moves across Japanese equities, the yen, and bond markets. Let me bring in our portfolio manager to walk through what happened today.
Thanks for having me. We saw a pretty robust session for Japanese equities today, with the Nikkei 225 closing up 3.923% at 54,720.66, and the TOPIX gaining 3.178% to close at 3831.0. Broader market indices also participated, with the Mothers Index adding 0.952% to 2,227.0 and the J-Right Index up 0.718% at 2033.5. On the currency side, dollar-yen moved to 155.859, up 0.423%, while commodities showed some interesting divergence, with gold in yen terms surging 9.003% to 17,980.0, and crude oil advancing a more modest 0.66% to 62.55. So overall, a risk-on session with strong equity breadth and some notable commodity strength, particularly in precious metals.
That's a strong rally across the board. But let's dig into some of the underlying stories driving these moves. We're seeing headlines about institutional positioning changes, particularly around Federated Hermes reducing its stake in Mitsubishi UFJ Financial Group. What should global investors make of this development?
This is definitely worth paying attention to. Federated Hermes is a major global asset manager, and MUFG is Japan's largest bank by market capitalization and a core holding in many international portfolios focused on Japan. When a prominent institutional investor trims a position in a bellwether name like MUFG, it can signal shifting views either on the Japanese banking sector specifically or broader economic conditions in Japan. The banking sector often serves as a proxy for domestic economic confidence, so moves like this get watched closely.
So what's the potential market impact here? Are we looking at pressure on the financial sector more broadly, or is this more idiosyncratic to MUFG?
In the near term, you could see some downward pressure on MUFG shares specifically, and potentially some spillover into the broader banking subindex within the TOPIX. The magnitude really depends on the size of the position that was trimmed and whether other institutional investors follow suit. From an FX perspective, the direct impact on the yen is probably limited unless this signals the start of broader foreign capital outflows from Japanese equities, which we haven't seen evidence of yet. On the JGB side, the immediate effect is likely minimal, though persistent foreign selling of Japanese assets could eventually influence demand dynamics in the bond market and put upward pressure on yields.
Staying with market structure, we also saw some interesting breadth data today. Reports indicate the Nikkei actually dipped 1.25% at one point during the session, with an advanced decline ratio of 0.66. Yet we still saw strong performance in names like Makita Corp, which gained 4.93%. How do you read that divergence?
That's a really important observation. An advanced decline ratio of 0.66 means you had more declining stocks than advancing stocks, which signals weak market breadth even as the headline index ultimately closed higher. This kind of narrow rally suggests that gains are concentrated in a relatively small number of large-cap names, which can create vulnerability if sentiment shifts. When you see that kind of divergence, with individual stocks like Makita surging nearly 5% while the broader market struggles, it typically reflects either sector rotation dynamics or company-specific catalysts like earnings beats or improved guidance. But the underlying message is caution, particularly for institutional investors who need to see broad participation to feel confident about sustained upside.
And what does that mean for the Nikkei and TOPIX going forward? Should investors be concerned about momentum stalling here?
If the weak breadth persists over the next few sessions, that would be a warning sign that momentum is indeed stalling. A sustained deterioration in the advanced decline ratio, particularly if we start seeing large-cap defensive names or the major exporters that have driven recent rallies begin to underperform, could signal we're entering a correction phase. From an FX perspective, if we do see a more pronounced equity sell-off, that would typically be yen supportive as risk-off sentiment tends to trigger unwinding of carry trades, which could strengthen the yen against the dollar. And in the bond market, equity weakness usually correlates with a flight to quality bid into JGBs, which would put downward pressure on yields, particularly at the 10-year maturity.
On the policy side, there's also been notable movement in the Japanese government bond market. We're seeing reports of a bond sell-off that's raising questions about fiscal sustainability. Can you walk us through what's happening there and why it matters?
Absolutely. Japanese government bonds have experienced a sell-off that reflects rising yield pressures and growing investor concerns about Japan's long-term fiscal trajectory. This is significant because Japan has one of the highest debt-to-GDP ratios among developed markets, and for years, the country has been able to finance its deficits at historically low yields. A bond sell-off suggests that investors may be reassessing their willingness to continue lending to the Japanese government at those suppressed rates. Given Japan's aging demographics and the persistent need for counter-cyclical fiscal policy to support growth, any constraint on fiscal flexibility could have meaningful implications for future economic policy.
So how does this play out across asset classes? What should investors monitoring Japan exposure be watching for in yields, the yen, and equities?
On the JGB side, we're likely to see continued upward pressure on yields, particularly at longer maturities. However, the Bank of Japan's yield curve control framework does provide some technical support and limits how far the 10-year yield can move in the near term. For the yen, a bond sell-off typically provides support through higher carry costs and improved real yields relative to other major currencies, though the BOJ's ongoing accommodative policy stance may cap that effect. As for equities, the analysis from Morningstar suggests limited near-term impact, which is somewhat reassuring. That said, if we see sustained rises in yields, that could eventually pressure equity valuations and increase borrowing costs for Japanese corporates. Domestic-focused, dividend-yielding stocks might actually benefit from a higher rate environment, while capital-intensive, growth-oriented names could face headwinds.
Shifting back to equities for a moment, how are you thinking about sector positioning in this environment? We've got strong headline equity performance today, but these crosscurrents around breadth, institutional flows, and rising yields create a more complex picture.
That's exactly right. The strong headline numbers today are encouraging, but when you peel back the layers, you see a market that's dealing with multiple crosscurrents. For global investors with Japan exposure, I'd be paying close attention to a few key areas. First, watch whether the weak breadth we saw intraday persists, because that will tell you whether this rally has legs or if it's running on fumes. Second, monitor institutional flows, particularly from foreign investors, because changes in positioning by major asset managers like we saw with Federated Hermes and MUFG can be early indicators of broader sentiment shifts. And third, keep an eye on the interaction between JGB yields and equity valuations, because if yields continue to rise, that changes the discount rate for future cash flows and makes equities relatively less attractive, particularly for long-duration growth stocks.
Meanwhile, in corporate news, the standout performer today was Makita Corp with that 4.93% gain. Any sense of what's driving that outperformance?
Makita's strong performance against the backdrop of broader market weakness suggests there's likely a company-specific catalyst at play. This could be related to earnings results, updated guidance, or perhaps stronger than expected export demand for their power tools and equipment. For a global investor, individual stock moves like this are less important than the signal they send about market dynamics. The fact that Makita can rally nearly 5% on a day when the advanced decline ratio is below 1 tells you that there's still appetite for quality names with clear catalysts, even when the broader market is struggling. That's actually a healthy sign that investors are being discerning rather than just buying or selling the index indiscriminately.
So bringing this all together as we wrap up, what are the key themes global investors should be taking away from today's session and this broader set of developments in Japanese markets?
I'd highlight three main themes. First, Japanese equities posted strong headline gains today, with the Nikkei up nearly 4%, but the underlying breadth was mixed, which suggests we need to see broader participation to confirm the rally is sustainable. Second, we're seeing some notable shifts in institutional positioning, particularly in the financial sector, which bears monitoring as a potential early indicator of changing sentiment toward Japanese banks and the broader market. And third, the bond market is sending signals about fiscal sustainability that could eventually constrain policy flexibility and influence the rate environment, with implications for both equity valuations and yen dynamics. For now, the impact on equities appears limited, but this is definitely a story to track closely in the coming weeks.
That's a really helpful summary. For our listeners who are global investors tracking Japan exposure, these are the kinds of crosscurrents that don't always make the headlines but can significantly impact portfolio returns. If you found today's discussion valuable, please consider subscribing to TOITOI Japan Market Radio for daily updates on Japanese markets. Thank you for joining us, and we'll see you next time.
Thanks for having me.